Hi, my name is Christina Strickland. I'm the managing partner of Rally Wealth and Benefits. And today we're going to spend a few minutes talking about the types of fixed income and what you need to consider when you're making that part of your investment portfolio. If you've been investing for any amount of time, you no doubt have had a conversation at some point with either a financial advisor, or you Googled it, or you talked to your family and friends about how much of your portfolio should include fixed income. What I want to do is break down the different types of fixed income and the risks that are associated with them, because I think what happens is a lot of individuals assume fixed income is a more conservative, or some people would say safe part of the portfolio, which is not always true. And in fact, in the investing world, I would say that nothing is actually safe. In fact, for compliance reasons, I'm pretty sure I'm not even allowed to say the word safe. But in this case, what I'm thinking of is, what are the incorrect assumptions that people make about fixed income, and where does fixed income fit in your portfolio? So the first thing to do is kind of define the different types of fixed income. So a lot of individuals are familiar with certificates of deposits, or CDs, offered through banks. They were super popular in the 80s and 90s when interest rates were insane. And because they were so popular in the 80s and 90s, it's really, really common for people to continue to use them today. There's also corporate bonds, where companies will let you loan them money for a rate of return that they'll put as a coupon on that corporate bond. So we'll get into that a little bit. Municipal bonds, United States Treasuries. Let's get into CDs. So again, in the 80s and 90s, CDs were super popular because they were paying really good interest rates. So if you bought a house in the 80s or 90s, you know what I'm talking about. I think my parents said the first house they bought in 85, the interest rate was like 13%, and they thought that that was a pretty good deal. Well, CDs are essentially just banks, right, giving you a rate of return in exchange for getting to use your money. So, for example, like 2 days ago, I bought a 3-month CD, and I think I got like 3.9% on it. And here's the thing, I want to be very clear: CD rates change all the time, and they are based on the duration of the CD, how long you're giving your money to the bank for. And they're also based on the amount that you are depositing into that CD. So you might see a stated rate for $100,000 or less being deposited, and typically there'll be a different rate if you're depositing over $100,000. So that's important to note, because some individuals will like to spread CDs out, or they'll do what I like to call the laddered CD strategy, which is basically where I say, okay, look, I'm going to put X amount of dollars away in a 3-month CD. And then I might do another 3-month CD 30 days later. And so the idea behind that laddered strategy is, every so often, maybe every 30 days or every 60 days, I have another CD maturing. That's a really popular strategy as a way to achieve liquidity, because I know, hey, every 30 days, no matter what, I've got another chunk of money becoming available to me. That's a great strategy when your perspective or your priority is liquidity. When your priority is within the CD kind of sleeve of your investments, when your priority is the highest attainable interest rate, then that other laddered strategy may not be as effective, because while the laddered strategy gives you a good liquidity cadence, because you're dividing your dollars up more, you're probably not going to get as much interest. And so that's where we kind of look at, hey, how much is your total earmark, or your total budget for certificates of deposit? Because you could be pretty close to that window of, hey, if I just don't split these up as much and put them all in maybe one 3-month or one 6-month, all of those dollars together, you may actually achieve a higher interest rate. And so whether or not that's what you want to do, that's, up to you and your financial plan, right? But I just want to point that out, because I see a lot of individuals that'll have CD dollars spread between like 7 or 8 certificates of deposit. But if they would combine them, they'd actually probably achieve a better result. Again, CDs are very different. It depends on what bank you're going to. Brick and mortar versus even online banks have different rates. It depends the duration. It depends the dollar amount. Callable or not. So callable CDs, the bank could say, hey, client, I know that I said I was going to give you this CD for 6 months, but I'm actually ready to go ahead and give you your money back now. If they do that, you're not going to get as much interest, right? Because they haven't held on to your money for as long. So those are all things that you need to consider when you're making the decision about where a CD does or does not fit in your financial portfolio. Another type of fixed income that people look at are corporate bonds or mutual funds or ETFs that buy corporate bonds. There's all sorts of ways to do it. You could buy it individually yourself on the open market. You could purchase an investment like a mutual fund or an ETF or a collective investment trust that owns bonds itself. But in general, right, corporate bonds are the company wants to raise money. And instead of giving away ownership, instead of issuing stocks, they're going to issue kind of like their own little loan note, right? So company says, hey, Christina, we want to raise $100,000 for XYZ project. A very popular example of that is how FedEx started FedEx Ground, was that they issued bonds. Or in Kansas City, a really big one that you'll see is retirement communities that want to expand their footprint. Maybe they want to open a new building or they want to open a new activity center. What they may sometimes do is issue a bond where they say, hey, look, investor or loaner in this case, because a bond is essentially a loan, right? In order for you to invest in my goal, what I'd like you to do is give me X amount of dollars. Let's just say, hypothetically, it's $10,000. Give me $10,000, give the company $10,000, and what they'll do in exchange for that $10,000 is they will issue you a bond that says, hey, we're going to have all your money paid back within probably 5 or 10 years normally. And in the meantime, not only will I give you every dollar that you gave me back in the 5 or 10 years, I'll also pay you interest in the meantime. And so a lot of investors like that because they know they're going to get their money back at the end of the time frame, or the duration, if you will, the maturity date. They also know they're going to earn the interest in the meantime. But here's the crux, right? It's a loan. Just like if I bought a house, I have a mortgage from the bank and I tell the bank, hey, I'm going to take 30 years and I'm going to pay you back. So every month I'm making principal and interest payments. The problem is it's a loan. There's no guarantee that, yes, absolutely on year 5 or year 10 or at that maturity date, I will have every dollar back. Now, typically in a company, you have access to information about their credit. You have access to information about their cash flow. You have access to information about their workforce, their turnover, all of these decisions that you should consider when you're deciding whether or not you'd like to invest in that company. But I think it's really, really important for people to know there's no guarantee that that's actually going to come back to you. Certainly, it feels less volatile than the stock market because you're not basing your outcome on whether or not somebody else wants to buy your share. You're basing your outcome on whether or not you think this company can fulfill their financial obligations. And so that's something that's really important for people to consider. I kind of look at it as if my next door neighbor asked me to borrow money, I would want to know, hey, next door neighbor, what do you need this money for? What are the financials that prove that you can pay me back? And because I'm taking this risk, what's my payment? What's my reward? And so that's the thing to look at when you're thinking about corporate bonds. How long am I giving my money for? 5 or 10 years or 1 year or 20 years, whatever that time horizon is, that duration. What is that maturity date? And what's in it for me? What's that interest payment in the meantime? How am I going to recoup my money? Plus also a little bit more than that, right? To pay me for allowing them to borrow my money. So that's corporates. Then you have municipals, which are very, very, very similar. Only the difference is it's an entity of the government. So it might be a city, it might be a county, it might be a state. Same thing though. What's your ability to pay me back? How long am I giving you money? When will I get paid back? And I will say though, because it's typically a city, county, state, sometimes it's a school district, there are normally, and you need to consult with your tax professional about this, but there are normally tax incentives, right? So a hypothetical example is maybe I loan some of my money in that I buy a municipal bond from Wichita, Kansas, for example, and they're going to pay me interest. Well, there may be, and again, check with your tax professional, but there may be a tax incentive that, hey, you're going to get this interest from the city of Wichita, Kansas in this example, and you're not going to have to pay taxes on it. And so that's something to consider as well, is Yes, I'm taking a risk still, right? I'm depending on their ability to pay me back, but maybe for tax purposes, that might actually be a pretty good deal for me because then I can compare, okay, look, on the corporate side or the CD side, I'm gonna earn X amount of dollars in interest, but I have to pay taxes on that, right? On the municipal side, I might be earning a little bit less, but again, kind of with that asterisk, at the end, if some of those dollars are tax free, that might actually be the better deal for me. And so that's called a tax equivalent yield. What that means is at the end of the day, I know what I'm going to earn from each of them, but after I've paid taxes on it, what's actually net to my pocketbook? And so that's a really important consideration when you're evaluating the fixed income side of your portfolio. The other part is treasuries. So T-bills, I-bonds, things like that, that are really popular. And I say they're popular because that's what most people know about. They were very, very common during the World Wars and times of conflict because the government needed to raise money. And so individuals will loan their money to the treasury. And again, there's a stated interest rate. What am I going to get? And those typically work a little bit differently in that a lot of those are not necessarily that you're getting an interest payment in the meantime. It might be, for example, I got a ton of these from my great grandma when I was little. She would always give me on my birthday this piece of paper, and it would say, "Hey, Christina, in 20 years, you can take this piece of paper to the bank and you can get $100 for it." So you could exchange that, right? I didn't get any interest in the meantime, but I had a piece of paper that I could take on, I don't know, my 25th birthday, for example. I could go into the bank and give them that bond and they'd give me $100. Well, the benefit was my grandma probably only spent $20 on the piece of paper. So the benefit was I paid $20. I waited X amount of time frame that they told me to wait. And again, I was going to exchange it for a higher amount of money. In this example, spent $20 on it, waited 20 years, and now I have $100. So I made hypothetically $80 in that example, right? Again, things to consider. What's the likelihood that I'm actually going to get that money back? Treasuries, I feel like, tend to have a little less risk, and I can't call them risk-free, and no one can ever call it risk-free. And I think this is an important thing to know. If you're talking to a financial advisor or anyone in the world that tells you that your bonds or your T-bills, whatever you're buying, if it's fixed income and they tell you that it's risk-free, you need to run for the hills because that's not true. It's all based on the assumption that this company, that this city, that this school district, this state, the treasury can pay you back. Now, you may have and should probably have a decent amount of respect for the people that you're loaning your money to, right? But it cannot be said with actual truth that it's guaranteed that that's going to come back. And I think that's really important because when people are designing their portfolios and they're thinking about what they want to do and they assume fixed income, a lot of investors assume that fixed income is just there. They take it for granted that that's always going to be there. And that is the goal, right? The goal of all investing is that your money's going to be there. But I just think it's really important to note it is still very much an investment and there is still very much a risk associated with it. You may determine that you feel more confident giving your money to a state or a school district, and that's totally fine. There's nothing wrong with that, but I just always want to put that plug out there that it is still an investment. There is still risk associated with it. Now, with that being said, I think we've killed that horse or hit that hammer enough that there is risk level associated with it. But other things to think about: liquidity. How long am I giving up my money? When you look at your portfolio and you're designing it, you need to think specifically about fixed income. When do I want to use this money? Because here's the thing. If it's part of your retiring portfolio, for example, and you're going to retire in a year or two, but that money's locked up for 5 years, probably not a great choice, right? If you need to access that money, you need to know how long are you locking it away for? When is the liquidity? When can I use these dollars? You also need to think through, typically, again, fixed income is to have a different level of risk than like the stock market, but there's also inflation risk. Is what I'm doing going to keep up with inflation? because I don't know if any of you have gone to the grocery store or bought gas recently, but it was a lot more expensive yesterday than it was a year or two ago. So can I keep up with inflation? Is it liquid or available to me when I need it? And also, how long is this supposed to last me? Because again, if my retirement plan is 10 years, that's a heck of a lot different than a retirement plan that's supposed to last me 30 or 40 years. So all of these are things that individuals need to think about when they're developing the fixed income part of their portfolio. The other thing I would just kind of add to it is the type of account that it's in. You need to think through as you're building your portfolio. For example, if there is a bond that has a pretty good tax strategy or a pretty good tax incentive, it wouldn't make a ton of sense to own that, for example, in like a Roth IRA. Because as you know, Roth IRAs, assuming you follow the rules, the 5-year rules and the age rules, if you follow those rules, then the Roth is going to grow tax-free and come out tax-free. So having a tax incentived bond in a bucket that's already pretty strategic on the tax front, that might not make a whole lot of sense. It might not be very efficient. So just when you're building your portfolio, you're thinking through your fixed income, keep in mind liquidity, duration, risk level, and just really make sure that you're taking a balanced approach to that. If you need help with that or you have any questions about fixed income, please reach out. We'd be more than happy to help.